loves to work and nothing all day. Oh, yeah, 'cause he's been taking care of business every day. Taking care of business every way. He's been taking care of business.
The planner has 5 tabs in which you can make adjustments. This video covers use of the Summary tab. The other 4 tabs are optional and allow you to better estimate some of the numbers you use in the Summary tab. They each have a separate video linked from the same web page on which you found this video. On the left of this tab are 6 areas of data. Your circumstances. This covers the required data need to run the model that only you can provide. Investment and cost variables. These are your estimates of the earnings rate your retirement savings will earn and the CPI percent you estimate will apply over the term of your retirement. Pension data. This data is presented so you can see the rates applicable in the current year. You can't change any of these as they are policy-based, with some being adjusted to CPI, usually every 6 months. Pension supplements. These are not applied in the model, but you may be entitled to these depending on how much of the full pension you receive. This is determined each year by Centrelink. The rules are complex and undisclosed, so the pension earnings we calculate don't include these amounts. This area is where you can use a reverse mortgage to supplement the super balance. A reverse mortgage is something that can be used if your plan indicates you might run out of super toward the end and you own your own home. You would need financial advice to decide if this is used at that time. The final area is where data related to rental assistance is displayed. Rental assistance is available if you otherwise qualify for a pension payment and do not own but rent the house in which you live. Other forms of rent, such as over 55 living fees, etc., can qualify as rent for these purposes. For this data to be used in the model, you must indicate no to the question, "We own the home in which we live or mortgaged," yes to the question, "Include rent assistance for non-homeowners only," and include your weekly rent amount. This assistance can dramatically change the financial outlook in retirement for renters. On the right are 3 charts which change depending on the data you change on the left. Chart 1 is the super closing balance until planned end of life. This shows for each year until your chosen end of planned year what your super balance is at the end of the year. If you click on the chart and then hover the mouse pointer over any of the columns, it shows the age year and closing balance for that year. Chart 2 is the summary of cash flows for retirement model by your age. This has up to 5 columns for each year, displaying the expenses in each year adjusted for inflation using the CPI percentage on the left. Pension net of income test, also CPI adjusted. Super fund earnings projected. The super drawdown required each year to match the expenses not covered by pension payments, and rental assistance received if you qualify for this supplement. Again, if you click on the chart and then hover the mouse pointer over any of the columns, it shows the age year and the value of expenses, pension, earnings, and super drawdown for that year, plus rental assistance if applicable. The data here shows this person would be 79 before receiving any part pension payments. Chart 3 is the super drawdown percent compliance by age. Depending on your age, you are required to draw down a minimum percentage of your super balance of each year to qualify the fund for tax-free status. The orange line is the required percentage, and the blue line shows the percentage actually drawn down for this model. This is here so you can make changes to your model to make sure you always qualify for the tax-free status, either by increasing your planned expense level or drawing down a capital amount and placing it in a term deposit, gifting it to family, etc. Over here, there is a click here to print button, which provides instructions on how to generate a custom printed report to paper or save to a PDF. As different devices and operating systems have different ways of doing this, we provide instructions rather than a print button that directly prints a report. Let's look at the data, shall we? You select your desired first year for retirement here. While this can be a year going forward, the usefulness of the model projections diminish as the gap between this year and the chosen year increase. Most would choose this year or the next year or two, as retirement is clearly something you are looking at sooner rather than later. If you are looking forward based on what you think you may have saved then, it is still a good guide, however. Next is the age you will be in that year. Are you single or part of a couple? And is either receiving a pension already? Age of your partner in the retirement year, if a couple. The next three fields are your estimates of the expenses in today's money you think you will need for each of the periods in the first 10 years, next 10 years, and after 20 years. Research shows that as you get older, you tend to spend less. We ask you to enter these rather than make an assumption like the free online models. Many of these use the Australian Super Fund Association, ASFA, researched expense levels for singles and couples living a modest or comfortable lifestyle. Others use the minimum super percentage drawdown as the expense level. The data in this example spends considerably more than either of those estimates. Herein lies one of the big traps of free online models. My wife and I have always considered we live a pretty simple life with well-managed and limited spend levels. If you are the same, then you will appreciate our conclusions. When we compared our actual expenses to the ASFA standards, we are well above the comfortable lifestyle. As an example, the overseas travel budget in ASFA assumes a trip every 7 years, and a modest one at that. We have 2 children living on separate continents we want to see regularly while still able. I also play golf regularly, and my wife is a practicing artist. Both of these activities are not accommodated in the ASFA numbers. The ASFA standard for a comfortable lifestyle for couples is currently around $73,000 per year. This example doesn't use near that level of expense until the after 20 years expense period. The detailed expense budget tab here allows you to better estimate your expense levels. Or you may know what you plan to spend each year at the beginning. You can just guess for now, or use the ASFA standard to start, and then use the detailed expense budget video to understand how to calculate a better estimate later. Next, choose the age you want the plan to end. This is the age at which you think your life may end. You can use one of the online life expectancy calculators, or like me, optimistically desire to live to a ripe old age. We don't allow for one partner to die in a different year, but you can redo the model, assuming that happens, and estimate how your partner's financial plan would look from that point. To estimate what would happen after you die, simply print your model so you have a copy of the numbers you used, then redo from the date you speculate death using numbers from that date to reflect a single person to get a plan from that year for your partner. Next is your estimated personal assets. essential for the assets test for pension calculations. This includes real estate other than the family home, vehicles, boats, caravan, etc. at their current market value, business assets, some of these are counted, household contents valued at fire sale value, not replacement value, jewellery, collectibles and antiques at their current market value, gifts by way of cash or assets sold at less than market value to related parties. The video on how to use the Personal Assets Calculator tab will assist you to get a better handle on this value. When you apply for the pension, you need to satisfy Centrelink you have done this as accurately as possible and then do it every year subsequently. Exclude financial assets such as bank accounts, term deposits, shares, managed funds, and superannuation. If you own your home or still have a mortgage, set this field to yes. If not, answer no. Then enter the opening super balance you anticipate in the first year of retirement. This will likely just be your super fund balance, but if you have bank accounts, term deposits, shares, managed funds that earn interest, include them here as they will add to your assets for the asset test and are also subject to the deeming process when assessing your income, just like superannuation. We will cover how this works when we discuss the pension data. If you rent your residence, make this field yes, and then enter your weekly rent amount here. The model will only include rent assistance if this field is yes and this field is no. The weekly rent amount then automatically populates the detailed expense budget with weekly, monthly, and annual rent value. Next, enter the average earnings rate you would use to estimate how much your financial assets will earn for you each year. How long is a piece of string, you may be thinking? For this model, we have used the 30-year average earnings rate for the Australian Super Choice account, 8.9%, discounted a little for safety margin. If you don't know this rate, ask your super fund to provide it. If they won't, it may be time for a financial advisor. The Investment Earnings Average Percent tab provides a way to estimate this if you have multiple super savings or other financial assets. Use the relevant how-to video when exploring that tab. Next is the inflation or CPI average percent you want to use. You can Google this detail to do your own research, but we have used 2.5%. Why? In 1993, the RBA was tasked with keeping the inflation rate between 2 and 3%. Over the 32 years since then, the average inflation rate in Australia has been, 2.5%. On that basis, we feel it is a pretty good estimate for the next 30 years, which should cover the plan period for most. You can change this once your model is set up to test safety margins should it change. Generally, the higher the inflation average, the more you need it at the start, and vice versa. Let's look at the pension data briefly, as you can't change this. We adjust it whenever the government makes new announcements for new model downloads to reflect the actual change in value. Values will vary depending on your single couple status selected. Upper asset limit annually. Total of financial and personal assets must fall below this level to become eligible for a part pension subject to the income test. Lower asset limit annually. Below this level, you receive the full pension subject to the income test. Pension this year, the full pension payable in the current year. Upper income limit. Above this amount, you receive no pension regardless of the asset test result. Lower income limit. Income below this limit is not included in the income test. deemed income asset threshold, financial assets threshold value that determines the deeming rate that applies. Deeming rate up to the threshold. This is the percentage assets below the threshold are assumed to earn. Deeming rate above the threshold. This is the percent assets above the threshold are assumed to earn. Notice the deeming rates are way below current super fund earning rates. This is where the magic comes into planning retirement, allowing you to earn the pension while still earning reasonable amounts in super as well. Asset test pension reduction per $1,000. This is the amount the full pension is reduced fortnightly for every $1,000 of assets above the lower asset limit. Upper income limit fortnightly and lower income limit fortnightly are simply the annual rates above divided by 26. Maximum pension fortnightly. Pension this year divided by 26. Work bonus per fortnight. Currently, there is an ability to earn an additional $300 per fortnight without affecting your income test as long as it is from personal effort, e.g. a casual job, a director of your own company, running a consulting business, etc. There are some complexities around this we have not included, so the impact may be understated a little. Next, there are pension supplements available. These need to be assessed individually by Centrelink, but most qualify for some of this on a sliding scale depending on the proportion to the full pension you receive. We have not included these, so there is likely some pension upside for most people in the model due to these supplements. Where the data is marked CPI based, they are automatically adjusted 6 monthly based on the determined CPI rate. Those marked policy based are adjusted by political whim and may not be available in the future. Under the rental assistance data area are amounts that can't be edited as they are set by policy. These are rent assistance minimum rent payment, rent assistance maximum rent payment, and the rent assistance rate per dollar over minimum rent payable until the maximum is paid. If you are entitled to rent assistance, your asset limits for part pension may be higher under some circumstances as well. You can only find out this difference when applying, as Service Australia do not publish this data. Now, let's look at the model in action. I will cover the reverse mortgage section as part of this example. First, we look at a homeowner example. In this example, we had someone retiring this year at age 73. They're in a couple relationship, neither are receiving a pension, and their partner is 66. Here we have expense levels that reflect their estimate that was made using the detailed expense budget. The person filling out the model believes they might want to live until 100, and they've estimated their personal assets at $40,000. They own their own home, and their opening super balance, including their savings accounts, is this number. We've chosen 8.5% as the investment's earnings average and an inflation average of 2.5%. This produces a financial model on the right, which ensures there's money right to the end, with $142,000 left at the end of the plan. Down here, we have the summary of cash flows, which shows that there is pension payable in the year the person turns 79, which continues to grow as the super fund balance reduces. And looking at this chart, the super drawdown in each year is pretty much what is required to be drawn down. There's a little bit of difference here, but that's a long way out and can be adjusted later. Okay, let's move some data around. So instead of couple status, let's change it to single. You can see when we do this, the first chart shows we run out of super at age 90, which is a bit early. Let's try something else. How about being overzealous with expenses as a couple, increasing the first 10 years to $125,000? Oops, ran out again. But we own our own home, so we can consider a reverse mortgage later on. With a reverse mortgage, you can draw equity from your home and accumulate interest until your estate is settled, incurring no outgoings until you die. The home is currently valued at $1.1 million, and the expectation is property values will continue to rise at the 30-year average for this suburb, 5%. We have used a 9% mortgage rate. Reverse mortgages are more risky, so the rate charged is higher. As we run out of money at age 90, we've set this to start drawing down at 90 and stop again at 99. Let's turn on the feature. So, $20,000 a year doesn't solve the problem, does it? So let's try $30,000. Still cutting it a bit fine, so let's do $40,000. Voila! Money till the end. As you can see, the inflation increase in the house value means it is worth around $4 million at the plan end, and after paying the bank back, there's nearly $3 million for the kids to inherit still. Whether you are wise to use this approach is something you need to assess and perhaps seek professional financial advice. We have included this option so you can see what the possibilities are and whether it is worthwhile paying for financial advice to see if it is right for you. Let's review another example to see if the drawdown compliance issue is addressed. Change back to being a couple and adjust the expense to about the ASFA comfortable standard, $75,000. Heaps of money left, right? But if we look at the compliance chart, we are below the compliance percent until 76, then again from 80 to 81, and then from 91 onwards. In those periods, we lose tax-free status, which will mean the super earnings are taxed at 15% instead of tax-free. Hands up if you want to give more money to the government. To overcome this, we must draw more money. Let's start with another $10,000 in the first 10 years. Let's whoop it up a little while we can. Pretty close to fixing the early years problems. Now let's spend another $30,000 and renovate the kitchen. We do that on this tab. There is a video on how to use this tab on the resources page. Now we just need to fix the latter years. We can give $10,000 a year without affecting our pension, so let's give to the children. But that doesn't fix it, does it? This suggests you may be planning to be somewhat too frugal for the super you have and may want to consider spending more on yourself earlier while you can enjoy it. It's up to you and a discussion with a financial planner perhaps. But you can see how the compliance chart helps you plan not to pay more tax than necessary. Another approach, when you aren't spending the required drawdown percentage, is to draw down the required amount and put any excess in a savings account or term deposit. Once at pension age, you'll be entitled to a low income tax rebate and a seniors tax rebate, which means you can earn $30,000 in taxable income and pay no tax. At 5% interest, that would be $600,000 you can put into a savings account without paying tax on the earnings, assuming no other income is earned. As a savings account, the balance is simply treated the same as your super and the deeming rate applied to determine income for the income test. This is simply an approach you might consider, and you would need to look at your overall tax situation before deciding what to do. Okay, now let's look at a renter example. We needed to change some fields from the previous example to remove home ownership, indicate rental assistance to be included, and add the weekly rent amount. Also, a higher expense budget is required to accommodate the rent. In the example, we've used the same expenses as in the previous example and simply added rent. We haven't changed any other expense except removing things like rates and repairs which don't apply to you if rented. You can see the dramatic impact Rent Assistant has by simply changing the inclusion flag to No. Rental assistance needs to be applied for separately to the pension and is only available once a favourable pension application has been made. When you use the planner, you may have some questions. We suggest coming back to the how-to videos first and then ask questions of the Facebook group to see how others have handled the particular situation if you don't think it's covered by the video.
Everywhere